Let us start with scale. Over the last 12 months, NVIDIA generated about $253 billion of revenue. AMD generated about $37 billion. So NVIDIA is already almost 7 times larger. Normally, a company of that size should grow more slowly, but NVIDIA's latest quarter tells the opposite story. Revenue reached $81.6 billion, up 85% from a year earlier. AMD also delivered excellent growth. First quarter revenue rose 38% to $10.3 billion. That would be exceptional for almost any semiconductor company, but NVIDIA is growing faster from a much larger base. Apparently, nobody told NVIDIA that large companies are supposed to grow slowly. The forward numbers are equally important. Analysts currently expect NVIDIA's fiscal 2027 revenue to reach roughly $394 billion, an increase of about 82%. AMD's 2026 revenue is expected at roughly $50 billion, about 43% growth. Both are benefiting from AI infrastructure spending, but NVIDIA is capturing far more of each new dollar. That gives NVIDIA the first clear advantage: greater scale, faster current growth, and stronger forward growth. AMD's case is not that it is already close. Its case is that even a modest gain in AI accelerator share could create substantial upside from a much smaller revenue base. Profitability. NVIDIA's latest quarter GAAP gross margin was 74.9%, AMD's was 53%. NVIDIA's operating margin was approximately 65.6%, compared with AMD's 4.4%. At a 65% operating margin, NVIDIA seems to be turning silicon into gold. The gap is not simply because AMD is badly managed. AMD is investing aggressively in instinct accelerators, ROCm software, networking, CPUs, and complete rack-scale systems. It also carries acquisition-related amortization that makes GAAP margins look weaker. On a non-GAAP basis, AMD's operating margin was 25%, but even that remains far below NVIDIA. NVIDIA's advantage comes from more than the GPU itself. CUDA, networking, systems, and a deep software ecosystem allow NVIDIA to sell a complete platform and maintain premium pricing. Looking forward, analysts expect NVIDIA's earnings per share to grow by approximately 50% annually over the next 3 years, compared with around 65% for AMD. AMD therefore has the faster expected growth rate, but it is starting from a much smaller earnings base and substantially lower margins. NVIDIA is expected to achieve roughly 50% EPS growth despite already operating at an extraordinary 65.6% operating margin. So AMD offers greater potential earnings acceleration, while NVIDIA combines strong future growth with far superior profitability. On a side note, do subscribe to the channel if you are getting value so far. Over the last 12 months, NVIDIA produced approximately $126 billion of operating cash flow and $119 billion of free cash flow. That is financial firepower. AMD produced about $9.7 billion of operating cash flow and $8.6 billion of free cash flow. NVIDIA's free cash flow margin is roughly 47%, compared with about 23% for AMD. Both companies are fabless, so they do not have to fund leading-edge factories in the same way as Intel or TSMC. But NVIDIA turns its revenue into cash at roughly twice AMD's rate. This matters because the AI race requires enormous research spending, advanced supply commitments, networking investment, and strategic partnerships. NVIDIA can fund all of that, repurchase shares, and increase its dividend without weakening the balance sheet. AMD has a healthy cash position, but its margin for error is smaller. The surprising part of the comparison, NVIDIA's market value is approximately $5 trillion, compared with about $883 billion for AMD. The much larger company may look more expensive at first glance, but the ratios tell a different story. NVIDIA trades at roughly 31 times trailing earnings and about 20 times forward non-GAAP earnings. AMD trades near 175 times trailing earnings and roughly 57 times forward non-GAAP earnings. NVIDIA's trailing price-to-sales ratio is about 20, compared with about 23 for AMD. And this is where the spreadsheet decides to play a practical joke. The $5 trillion company is cheaper on forward earnings and sales multiple than AMD. NVIDIA's free cash flow yield is also higher at roughly 2.4% versus about 1%. One caution: NVIDIA's latest GAAP earnings included a large gain on equity securities, so the forward multiple and cash flow yield are cleaner comparison measures than trailing PE alone. These figures do not mean NVIDIA is cheap in an absolute sense. A $5 trillion valuation assumes extraordinary AI spending and sustained competitive leadership. But relative to current earnings and forecasts, NVIDIA is substantially cheaper than AMD. AMD's valuation assumes that future AI accelerator revenue and margins will rise sharply. If MI450 and Helios gain meaningful share, today's earnings multiple can fall quickly. If execution disappoints, however, AMD has much less valuation protection. At current prices, AMD is the higher expectation stock, even though NVIDIA is the dominant company. Looking at historical stock performance, NVIDIA has been the stronger long-term compounder. Using split and dividend-adjusted prices for the 5 full calendar years through the end of 2025, NVIDIA delivered an annualized return of approximately 70%. AMD returned approximately 18% annually over the same period. Over the 10 full calendar years through 2025, NVIDIA's annualized return was approximately 73%, compared with approximately 54% for AMD. These are extraordinary returns for both companies. They also demonstrate how sensitive annualized returns can be to the chosen starting date. AMD performed extremely well over 10 years, but its weaker periods during the most recent 5-year window reduced its 5-year annualized return. NVIDIA's AI-driven rise was more consistent across both periods. The recent picture, however, is very different. As of July 21st, 2026, AMD had risen approximately 246% over the preceding 52 weeks, compared with about 20% for NVIDIA. Therefore, NVIDIA has been the stronger long-term compounder, while AMD has generated substantially stronger recent momentum. But AMD's recent return has also come with greater volatility. AMD's 5-year beta is approximately 2.47, compared with 2.21 for NVIDIA. A beta above 2 means both stocks have historically moved much more aggressively than the overall market. AMD has been the slightly more volatile of the two. Short interest tells a similar, although less dramatic, story. Approximately 2.5% of AMD's outstanding shares are sold short, compared with about 1.28% for NVIDIA. Neither percentage indicates extreme bearish positioning, but investors are expressing somewhat greater skepticism toward AMD. Overall, historical performance favors NVIDIA. AMD currently has stronger share price momentum, but investors are accepting greater volatility and a higher valuation to participate in that momentum. NVIDIA has delivered the better long-term record with slightly lower, but still very high market risk. Just a quick disclaimer, this video is not a financial advice. Analyst targets and market expectations. Stock Analysis gives NVIDIA a strong buy rating with an average price target of approximately 303. That represents around 46% upside over the next 12 months. Its most optimistic analyst target is as high as 500, implying potential upside of 141%. MarketBeat gives NVIDIA a moderate buy rating, but its average target is almost identical at 304. AlphaSpread also arrives at an average target of around 303. Therefore, despite using different analyst groups and methodologies, all 3 platforms produce a remarkably consistent outlook for NVIDIA. The picture for AMD is quite different. Stock Analysis gives AMD a strong buy rating and an average target of 542. Because the stock is already trading close to that level, the consensus target implies very little movement over the next 12 months. However, its most optimistic analyst target is 725, representing potential upside of around 33%. MarketBeat gives AMD a moderate buy rating, but its average target of 469 implies around 14% downside from current levels. Its most optimistic target is also 725. AlphaSpread's average forecast is approximately 508, representing potential downside of around 7%. So, while analysts generally remain positive about AMD as a company, their average price targets suggest that much of the expected growth may already be reflected in its share price. Unlike NVIDIA, where the different platforms point toward a similar and meaningful upside, AMD's forecasts are more widely dispersed and generally indicate limited near-term upside or even some downside from current levels. Both balance sheets are strong. At the latest quarter end, NVIDIA held about $50 billion of cash and marketable debt securities before considering its large equity investment portfolio against roughly $8.5 billion of debt. AMD held about $12.3 billion of cash and short-term investments against $3.2 billion of debt. NVIDIA's basic share count declined by roughly 1% over the last year, while AMD's increased by about 0.5%. Both companies repurchased shares in their latest quarters, but the scale was very different. NVIDIA spent approximately $19.3 billion on regular buybacks, compared with $221 million for AMD. Including shares withheld for employee plan taxes, AMD's total repurchase-related cash outflow was $355 million. NVIDIA also authorized an additional $80 billion of repurchases. Apparently, NVIDIA's buyback plan is larger than the entire market value of many publicly traded companies. NVIDIA is currently able to combine faster expansion with stronger shareholder returns. Business overview. NVIDIA dominates AI, AMD is more diversified. NVIDIA's latest quarter was overwhelmingly driven by data center, which produced $75.2 billion, about 92% of total revenue. Data center compute alone reached $60.4 billion, while networking reached $14.8 billion. AMD's mix is broader. Data center generated $5.8 billion, client and gaming $3.6 billion, and embedded $873 million. This diversification gives AMD meaningful exposure to EPYC server CPUs, Ryzen PCs, Radeon graphics, game consoles, and embedded computing. It can soften weakness in one product category, but it also means AMD is not yet as pure a beneficiary of AI accelerator spending. For NVIDIA, concentration is both the strength and the risk. If AI infrastructure spending continues at today's pace, NVIDIA is positioned at the center of it. If hyperscalers slow spending, develop more internal silicon, or demand cheaper alternatives, the effect on NVIDIA would be immediate. The most important difference is not simply NVIDIA GPU versus AMD GPU. It is NVIDIA's platform against AMD's attempt to offer customers a credible second ecosystem. NVIDIA combines accelerators, NVLink, networking, complete systems, and CUDA software. Developers have spent years building around CUDA, so changing suppliers can require engineering work, retraining, and performance optimization. That switching cost is one of NVIDIA's strongest competitive advantages. AMD may offer the alternative route, but NVIDIA has spent years building the highway, the toll booths, and most of the vehicles traveling on it. AMD counters with competitive instinct hardware, EPYC CPUs, ROCm software, and more open customer choice. Its opportunity is enormous because cloud providers do not want to depend completely on one supplier. AMD does not need to overtake NVIDIA to succeed. It only needs to become the dependable number 2 platform and capture a larger share of a rapidly expanding market. NVIDIA's next major catalyst is the Vera Rubin platform. The company is positioning Rubin as the successor to Blackwell for increasingly large agentic AI workloads. It is also expanding networking and optics, which allows NVIDIA to capture more value from each AI factory rather than selling only processors. AMD's major catalyst is the MI450 series and the Helios rack-scale platform. Customer engagement has strengthened, and AMD says leading customer forecasts are exceeding its initial expectations. Meta plans deployments of up to 6 gigawatts of AMD Instinct GPUs, beginning with a 1 gigawatt MI450-based deployment. Microsoft has also expanded its long-term relationship with AMD around future Instinct accelerators and EPYC processors. The key question is execution. NVIDIA's demand is already visible in reported revenue. Much of AMD's strongest AI case still depends on future product ramps and large deployments arriving on time. That gives AMD more potential surprise, but also more execution risk. Risks and verdict. NVIDIA's biggest risks are the scale of expectations, dependence on continued hyperscaler spending, competition from custom chips, supply constraints, and restrictions on sales to China. Its second quarter guidance assumes no data center compute revenue from China. At a $5 trillion market value, even excellent growth may disappoint investors if it merely matches expectations. AMD's biggest risks are execution, software adoption, lower margins, and a valuation that already anticipates major AI success. Its opportunity is compelling, but the company must convert partnerships and product announcements into sustained accelerator revenue. My conclusion is that NVIDIA is the better stock at current prices. It has the stronger platform, much greater AI scale, superior margins, dramatically higher cash generation, and, surprisingly, the lower forward earnings multiple. AMD may deliver higher upside if it gains more AI share than the market expects, but at today's valuation, investors are already paying heavily for that possibility. AMD remains a serious challenger, but at current prices, NVIDIA offers the stronger business and, surprisingly, the less demanding valuation. That verdict can change. I would become more positive on AMD if MI450 and Helios deployments translate into faster revenue growth, expanding gross margins, and a lower valuation relative to NVIDIA. For now, NVIDIA wins. Not because AMD is a weak company, but because NVIDIA currently offers the stronger combination of quality, growth, and price. Do subscribe to the channel to get more stock comparisons like these. If you liked the video, please give it a thumbs up. Thank you for watching, and I will see you in the next one.